Volpocalypse, Volmageddon, Volnado, whatever combination of natural disaster you want to call it, February 5th, 2018 will be burned into the memories of all volatility traders for the rest of our careers. On that day, the VIX index spiked 115%, which was the largest volatility spike since Black Monday in October 1987. And the end result was the old XIV, which was a favorite for many volatility traders. It crashed 96% in a single day, and it was terminated due to the acceleration clause being triggered by losses that large. Now remember, I'm a person who believes that all investors should have some exposure in their portfolio to a short volatility strategy. But how can anybody have confidence shorting volatility when they've already seen how disastrous it could be on one of those shock moves? We have to put people's mind at ease here a little bit and explain while Volpocalypse might have been very scary, it was probably just a one-off event. Now remember, volatility ETPs are not stocks, and they don't derive their price based on regular supply and demand dynamics in the market. They are best viewed basically as a formula. Volatility ETPs derive their price entirely based on the methodology of holding and rolling the front 2 months of the VIX futures as we proceed through the expiration cycles. Now, I've got several videos on this topic, but I'll point you to the best one right here. But the key point to understand here is whatever direction those VIX futures go, that's the direction the volatility ETPs will go as well. So the ones you've probably heard of, VXX, UVXY, UVIX, these are long volatility products, and if the VIX futures go up, those will go up in price as well. SVXY and the SVIX, plus the old delisted XIV that we're talking about, these are inverse volatility products, and if the VIX futures go up, those ones go down. So clearly those VIX futures did spike to an extreme level because it did terminate the XIV in a single day kill shot. But the thing you have to understand is that was not a natural outcome of the volatility spike itself. If the VIX futures market functioned normally that day, the XIV would have only lost about 30% of its value. The reason that loss went from 30% to 96% that day was a liquidity crisis in the VIX futures market itself. All of the volatility products have to do a daily rebalancing at the end of the day. They actually go into the futures market and buy and sell the ones they need to make sure that they start the next day with the right exposure to match their leverage factor. So simply put, what caused Volpocalypse was that there was an enormous amount of volume that had to go through that VIX futures market in a very short window of opportunity right at the end of the day. It was just too much for the VIX futures to handle. And like I said, what should have been about a 30% loss given the market move, it turned out to be a 96% loss and a memorable disaster for all of time. So because of all these changes, the volatility space is now far safer than it was back in 2018. It makes it nearly impossible for a repeat of Volmageddon. Now that doesn't mean that large single-day losses can't happen. Of course they still can, that's why we always put risk management at the forefront of all of our strategies. But it does mean that single-day losses now wouldn't be due to structural reasons like they were during Volpocalypse.